Welcome back to Investing Talk Podcast. Today, we're digging into the sources you sent over about AST SpaceMobile. This one. It's definitely exciting, maybe a bit terrifying too, right? In the satellite space. And the big question for us and for you listening is pretty straightforward. Is AST SpaceMobile actually a good buy right now?
It really is. This is almost a textbook case of a pre-commercial venture. High risk, potentially very high reward. Our job today is to kind of sift through the hype, look at the signals from their finances, the tech potential, and what the market's saying through the charts.
Okay, sounds like a plan. But before we jump right into all that, please do hit subscribe, like the segment, and drop a comment. We really want to know what you think. And hey, if there's another company you want us to tackle next, just leave its name in the comments below. We do read them.
Definitely. So, right, to understand the volatility with this stock, you have to start with the basic situation. They're building something huge, a global project, and that costs a lot of money.
Okay, let's unpack that financial reality then. Looking at the Q1 2025 numbers, it really confirms they're still deep in the building and testing phase.
Precisely. They're in the building stage, absolutely not the profit from it stage yet. Revenue, it's minimal. We're talking just, $0.25 million for Q1 2025. That tiny bit of income is just from small pilot programs, proof of concept stuff. It's not material at all.
Okay.
What is material is how much they're spending, the burn rate.
And that burn rate, it looks pretty significant.
Oh, it is. The net loss for that quarter was $60.1 million. Now, that loss isn't necessarily a failure, you see. It's kind of the cost of entry for what they're trying to build, this future global connectivity. That figure mostly covers heavy R&D and the costs of getting their satellites up there. So investors really need to expect these losses to continue until the main commercial launch happens.
Which is slated for when, roughly?
The target time frame is somewhere between 2025 and 2026.
Okay, so the obvious question then is, with that kind of spending, how long can they keep going? What's the runway? The liquidity report showed, $203.7 million in cash and equivalents at the end of March 2025. And debt seems okay at $54.2 million.
That runway figure. That's probably the single most defining metric for the company right now. Management has stated publicly that this cash should keep operations funded through early 2026.
So right up against that commercial launch window.
Exactly. Which means the whole investment thesis hinges, really, on a major earnings inflection hitting right on schedule. If that commercial rollout slips, even by a few months, well, the financial picture changes dramatically. The analysts, the sell-side consensus, they're all banking on significant revenues starting to flow in 2026 and really picking up steam into 2027.
That feels like a very aggressive timeline. It must require some kind of massive technological advantage to justify burning $60 million a quarter, right? I mean, what makes this company worth that kind of bet? Why can't someone like Starlink just decide to do the same thing?
Right, and this is where we get to the technological moat. This is where it gets really interesting, I think. Their whole goal is to be the very first space-based cellular broadband service that connects directly to a standard mobile phone. The one you already have.
Without needing any special dish or terminal?
Exactly. No special equipment. Just your existing phone. That's the revolutionary part.
Wow, that sounds incredibly difficult from an engineering perspective.
Oh, it's a huge physics challenge. I mean, standard phones have tiny antennas and very low power output. They weren't designed to reach a satellite hundreds of miles up. That's why AST SpaceMobile satellites, the Blue Walkers, have to be so enormous. They're essentially building the largest, most sensitive cell towers ever, just orbiting in low Earth orbit to pick up that weak signal and beam service back down.
Okay, I see. So that technical approach is the core difference.
It is. And that difference creates potentially a huge technological and regulatory edge.
So while competitors, like you mentioned, Starlink or maybe OneWeb, they focus more on needing special ground terminals or fixed broadband, AST SpaceMobile is aiming for this massive untapped market, like true global cell coverage everywhere, off-grid, rural, maritime, using the phones people already own.
Precisely. And that distinction is what forms their competitive moat. They've got the intellectual property, dozens of patents, some granted, more pending, and they're actively navigating the regulatory maze worldwide, trying to lock down the satellite spectrum rights they need. It's all about building that first mover advantage.
And they've got some serious backup in this effort, too. You mentioned the partnerships, AT&T, Vodafone, Rakuten. Those are global giants.
Absolutely. And these aren't just flimsy agreements. These partnerships give them immediate potential access to, billions of existing subscribers globally.
Yeah.
It basically creates a customer pipeline ready to go the moment the service is live.
So it potentially solves the customer acquisition problem from day one.
Potentially, yes. And crucially, we know the basic technology works. They had successful tests with their Blue Walker 3 satellite back in August and September 2025. Those tests showed they could handle voice and data off-grid, connecting directly with phones on the AT&T and Vodafone networks. That kind of validation significantly cuts down the perceived technical risk.
And that reduction in risk seems to have lit a fire under the stock price.
You can see it directly in the charts.
Yeah, looking at the trading data, the momentum is clearly positive. The stock has been in a strong uptrend. It climbed from a 3-month low around $31.73 to, what was the recent close? Near $48.84 in late September.
And the technical indicators back that up. The current price is holding above its 50-day simple moving average, the SMA, which is around $48.36. And it's well above the 200-day SMA, which is way down at $33.47.
Right, and for listeners maybe less familiar with technicals, that 50-day crossing above the 200-day, that's often called the golden cross, isn't it? It's seen as a bullish signal.
That's exactly right. It generally signals a confirmed shift towards a longer-term uptrend and indicates strong buying interest or accumulation over the medium term. Plus, the fact that the stock closed positive, had green days on 15 out of the last 30 trading days, that points to steady underlying buying pressure.
What's also interesting here is how that price action seems to line up with what insiders and institutions are doing. There's evidence of confidence there, too.
Absolutely. If you look at the Form 4 filings from July and August 2025, you see significant open market purchases by company directors and executives, people inside the company buying shares.
And crucially,
no major insider selling reported during that time. The people with the best view of the operational progress and risks are putting their own money in. That's usually a pretty powerful signal for the market.
and the professional analysts seem to agree with that bullish sentiment. The sources mentioned 7 analysts covering the stock.
Yes, 7 analysts rated to buy. The consensus price target range is somewhere between, say, the low $40 and the high $40. They're all basically anticipating a major positive shift for the stock as commercial service gets closer.
Okay, strong tech validation, big partnerships, insider buying, analyst support, positive charts. But now we have to talk about the elephant in the room, as they say.
Right. The valuation.
We've established it's a company with hardly any revenue right now, and it's burning cash quickly. Yet the stock price, it seems priced for perfection, doesn't it?
That's the heart of the high-risk part of the equation. The valuation is, well, extremely elevated. Shockingly so, some might say. Looking at the metrics, the price-to-book ratio is about 15.2 times. Compare that to the broader industry average, which is closer to 1.6 times.
Wow, 15.2x versus 1.6x. That's a huge difference.
It's massive. It means the current stock price isn't just reflecting expected success. It's pricing in, like you said, perfection. Revolutionary, flawless execution, and maybe even global dominance.
So what does that practically mean for you, the listener, if you're thinking about investing?
It means this is a classic sort of binary bet. You're paying such a high premium up front that any stumble, any delay in the rollout, any technical snag, any regulatory hurdle could potentially trigger a very sharp, very painful drop in the stock price. There's basically zero margin for error built into this valuation. The market's tolerance is extremely low right now.
And the risks aren't just theoretical market reactions. They're tangible operational risks, too. We talked about the high cash burn and that tight early 2026 runway.
Exactly. If commercial service takes longer than planned, they will burn through that $203 million cushion.
Which
immediately raises the risk of needing more money. That means potential dilution for current shareholders. We're already hearing some market chatter rumors about a possible equity offering down the line to raise more capital.
And if they do issue more stock.
If that happens, existing shareholders would own a smaller piece of the pie, which usually pushes the stock price down in the near term, even if it secures the company's long-term future.
So investors today are essentially betting heavily on flawless execution over the next, 12 to 18 months?
That's a fair summary, yes.
Okay, so for anyone watching this closely, maybe looking for shorter-term moves, the next few months seem critical. What are the specific catalysts we should all be watching for?
Right. There are 3 main areas to keep a close eye on, things that could really move the needle. First up is the Q3 2025 earnings report. That's expected sometime in November. Now, the actual revenue number will still be tiny, insignificant, really. What the market will be watching for is management's commentary, updates on cost control, cash burn, and most importantly, any progress reports on the first beta deployments of the commercial service.
So news confirming they're still on track.
Exactly. Good news there reinforces the timeline. Second key area, regulatory progress.
This is about getting the green light to actually operate beyond just testing, right?
Correct. We need to watch for crucial approvals from the FCC here in the U.S. and also from foreign regulators. These approvals are needed for expanded testing and eventually for full commercial service licenses. These are widely expected sometime in the fourth quarter of 2025. Getting those regulatory nods would remove a huge chunk of execution risk.
Okay, earnings updates and regulatory approvals. What's the third area? You mentioned whispers.
Ah, yes, the rumors. This is the wild card category. Two main types of chatter floating around. First, there's speculation about potential additional major partnerships with mobile carriers, maybe more in North America or possibly in Europe. Another big name signing on would be a huge validation.
And the second type of rumor.
Ongoing M&A speculation, talk that AST SpaceMobile might be an acquisition target for one of the giant global telecom companies.
That M&A angle is always interesting. Would that be seen as a good thing, like a validation, or more like a lifeline if they were struggling?
Given the context we discussed, the successful tech tests, the insider buying the market right now seems likely to interpret serious M&A interest as a major validation of the technology and its value. A takeover by a big telecom would instantly solve the funding runway problem and de-risk the execution significantly. It would confirm the value of their patents and spectrum rights. If those rumors gain real traction, that could unlock major upside pretty quickly.
Okay, so let's try to pull this all together for everyone listening. We're looking at a stock that's definitely high volatility. It's pre-revenue, but it has this really unique and powerful technology. It's got strong backing from institutions and insiders, but at the same time, it carries this extreme valuation risk, and it's operating on a pretty tight funding schedule.
Yeah, connecting all those dots, the overall picture, it leans bullish, but with major caveats. It's an exciting play on potentially disruptive global connectivity in an untapped market. It's a bet on that first mover advantage holding strong. So
Yeah.
you could see it being attractive for maybe short-term traders playing these upcoming catalysts we just talked about.
The earnings, the regulatory news, the rumors.
Right. Or for long-term investors willing to stomach the volatility, seeking those potentially huge asymmetric returns that only truly disruptive tech might deliver.
A high-risk, high-reward profile, clearly defined.
Absolutely. But here's maybe a final thought to consider as you weigh all this. Given that very high price-to-book ratio, that 15.2x number, the market is demanding near perfection right now. So the question is there any margin of safety left in that price? What happens if there are even minor delays in those critical Q4 2025 regulatory approvals or the initial commercial ramp-up? Is that possibility factored in at all?
That really is the multi-million, maybe billion-dollar question, isn't it? Whether this volatility resolves upwards or leads to a sharp correction. Well, we hope laying out these pieces helps you make a more informed decision. Thanks for joining us for this look at AST SpaceMobile.